Okay, good evening. This is Professor Mayer, and this is February 22nd, and we are continuing our discussion related to the role of the controllership, and we're talking specifically related to the control over inventories. Okay, so let's just kind of set some ground rules related to this. Inventory is different depending upon the type of the organization. If you are a retailer, you are buying the goods and you are selling these goods. So the issue that you are concerned with is you clearly are concerned to make sure that you've got controls over the inventory so that what goes out the door is in fact items that you've actually sold. You're also concerned with having the appropriate level of inventory. But that is really some of the issues that you're concerned with. You're concerned with making sure that you don't have too much inventory, you don't have too little inventory. A little bit different as compared to a manufacturer. So a manufacturer is actually manufacturing inventory. So when we talk about manufacturing inventory, you have other issues that you need to be concerned with in terms of how you're allocating direct and indirect costs to the inventory. You clearly want to be concerned with the inventory because the inventory can in fact be set up in such a way that if you have an absorption cost inventory system, that if you increase the inventory, you actually are absorbing costs from the expense side, and it's ending up in our balance sheet as part of work in process and our finished good. There's a lot of things to consider related to inventory. We also want to consider the fact that inventory is different as compared to supplies. So as an example, I have a hospital background and we don't have inventory, but what we have is supplies. Well, what's the difference between supply and inventory? Well, inventory are things that you actually sell. So I always give this illustration specifically related to healthcare is if you want a Band-Aid, you go to Duane Reade or Walgreens or whatever drugstore that you want to go to. You go in there and you buy a Band-Aid. Okay? So what is a Band-Aid? Well, a Band-Aid for the store is going to be part of our cost of goods sold, and you've actually reduced inventory and have cost of goods sold. Consider that same Band-Aid when you go to an emergency room. Well, you don't go to an emergency room to buy Band-Aids. But in fact, as part of the process of taking care of you, the doctor may or the nurse may in fact put a Band-Aid on your arm or whatever. That Band-Aid is a part of the revenue process. The revenue process is the patient encounter. And the difference being is that the item that you're using, which is the Band-Aid, is essentially used as part of the revenue process or the patient encounter, but you're not specifically going there to buy the Band-Aid. So the Band-Aid essentially becomes an expense, and the expense is essentially the expense supporting the patient encounter. So supplies, we have the debit account on the balance sheet, which is supplies, and then as we consume supplies, these items become supply expense. Inventory, different. Inventory stays on the balance sheet as inventory, and then as we sell this inventory becomes cost of goods sold. Critical issue, and especially a critical issue as we are considering how we're actually managing the process related. We want to talk about this from the perspective of internal controls. And we clearly have talked about internal controls as the whole system of controls established by management to effect an orderly and efficient manner, adhering to policies, safeguarding assets, and as far as possible, the completeness and accuracy of record. What does this have to do with inventory? Well, inventory is a big deal, depending upon the organization. It may not be a big deal in some types of organizations. If you are a tax preparer, inventory is not a big deal. If you are a retailer, inventory is a significant deal. If you are a manufacturer, inventory is a significant deal. So what you're interested in is figuring out how to actually manage this inventory in such a way that you are preventing bad things from happening. You're reducing the risk. Some of the risks are that you buy inventory and it expires. Maybe it has an expiration date, or you buy inventory and it's stolen, or you buy inventory and it's broken, or you buy inventory and somewhere in the process between the receiving and actually adding to inventory, it's destroyed. There's all kinds of things that could happen to inventory, and inventory essentially is your lifeblood to the organization, and we need to understand what the controls are related to this process. So let's talk about some specific controls. As we're looking at this, you notice the things that we're looking at. We're looking at considering the carrying cost. We're looking at considering just-in-time inventory systems, other inventory control issues, metrics, and internal controls. Okay, so let's kind of talk through a couple of these things. So when we talk about just-in-time inventory, we're really asking the question, how much inventory should be kept on hand? And the issue becomes is we have carrying costs and we also have shortage costs. And let's sort of talk about this from a sort of a practical perspective. So from a practical perspective, if you buy too much inventory and your inventory just sits there, there is risk to the organization. Well, what are some of these risks? Well, part of the risk is the fact that you now have inventory. You have an asset that essentially is consuming resources because you're paying for this inventory and it's not doing anything. It's just sitting on your shelf. You also have the excess costs associated with storing the inventory, so you need space for this inventory. You need insurance to cover anything bad that might happen to the inventory. And then you also have the risk of, and it becomes obsolete. So if you're a computer manufacturer, well, what happens? Well, inventory that you have today, 6 months from now, may in fact, there may be no value because technology changes and all that kind of stuff. So you need to be aware of the fact that having inventory sitting on your shelf is a very, very bad thing, especially if it's just sitting there and it's not creating any value at all. It's an asset, but it's not a value to the organization. It's not moving you where you want to be. So the issue becomes, okay, so let's cut inventory down to its absolute bare minimum. Well, there's risks there. And the risk is what we're calling shortage cost. So let's just kind of talk through the shortage cost. So if you are a retailer and you are selling goods, person comes in and says, okay, well, I want item number XYZ. You don't have item number XYZ because you forgot to order it, or the inventory ran out and you just don't have it. From a cost perspective, you've essentially lost the sale, and this is what we're going to call the opportunity cost. Think of it from a different perspective. Let's say we're actually manufacturing goods and services, and we're looking at inventory in terms of the raw material. So raw material comes in, and we're essentially using this raw material as part of the manufacturing process. From a just-in-time perspective, we keep inventory at its very minimum. The problem is we run out of inventory. So if we run out of inventory, what does that mean? Well, that means that it basically shuts down the complete line. So you've got people in the manufacturing area, you're paying them. They're willing to work, but they can't do anything because the goods are not there. So there is a specific shortage cost specifically related to not having the appropriate inventory or raw materials as you are manufacturing. Now consider this also from a hospital perspective. I always love to include hospital illustrations. So let's say you go into surgery. The doctor says, okay, so I want a pint of blood, I need a stent, I need this, and I need that. And you're the inventory person, and you say, oh, well, we're out of that inventory right now. We'll get it in tomorrow. Okay, so the issue becomes is that if you have a shortage, there is a specific cost, there is an opportunity cost There's a direct cost in terms of loss of value to other components within the manufacturing process, and there is just a significant risk for certain types of events where not having inventory is in fact a catastrophic situation. So this is the dilemma. The dilemma is that it costs money to keep inventory. We don't want to have too much inventory for all the reasons that we've talked about, but we don't want to have too little inventory because of the things that we've talked about. So how do we actually manage inventory? Which gets to the question is, why do we have inventory? To sell goods, because of unknowns, to mask operational problems. Let's just kind of talk through this. I've been in organizations where that we keep a surplus of inventory because nobody trusts anybody. And in fact, essentially what takes place is there's inventory, but then every department then sort of squirrels away their component of the inventory because they don't trust the system. They're afraid that if something goes wrong, that at least they're going to have the inventory. What we need to understand is that there is a process related to inventory control, and this process related to inventory control really means that everybody needs to work together in terms of managing the inventory. And managing the inventory means that you ultimately need to trust the system. There are carrying costs related to inventories. There's opportunity costs that we've talked about. There's obviously the risk of obsolescence. All of these things are going to drive the cost associated with the inventory and is really going to sort of help us understand why inventory becomes so important to the organization. There's clearly going to be a risk of damage or theft. If we have excess inventory on our shelves, it becomes very easy for people to figure out, well, you know what, it's not going to be sold, it's just going to sit here till it expires. Let me just take some of this stuff and nobody's going to be aware of it. It's not going to cause any problems. So there's going to be a justification related to theft. Damage is basically the fact is that it's sitting there, and it's a cost to you not only to hold the inventory but also to manage the inventory from a risk perspective. It's very possible that that rain could come in, destroy the inventory. It's very possible that the inventory will expire. Just kind of visualize managing inventory related to any type of commodity. You need to have the inventory there. The inventory will expire, and you need to make sure that you're able to actually manage that. We do have storage costs, we have handling costs. So all this stuff then is a part of the process. Well, so we've talked about the costs incurred. If we don't have the inventory, we have lost sales, we have damaged reputation, disruption of operations, expedited shipping costs. Well, expedited shipping costs essentially is that if we don't have the inventory, but we've promised to have the goods shipped to someone, what happens? It means that we are going to have to do a rush job in terms of the manufacturing of this product, and then when it's finally done, it's going to be shipped not at the ground level, but we're going to have to do Federal Express, airdrop it, because we're essentially catching up to what our commitment is to the customer. And again, just kind of visualize the hospital situation where we've got a surgery, we don't have the goods and services to complete the surgery. It's not an option to say, okay, well, we're going to defer the surgery. So what do? Well, you get on the phone and you get the stuff over there immediately, but you're going to get it over there immediately with an exorbitant cost of the product. So we need to understand that there is a significant cost associated with these goods if in fact we don't have them available. So we talk about a just-in-time inventory system. Just-in-time inventory system works when it works. When it doesn't work, it can be quite catastrophic to an organization. So in a just-in-time inventory system, is what we're doing is we are attempting to reduce the inventory levels by acquiring it just in time to be used. Essentially, just kind of think about this, is the just-in-time inventory system sort of emanated from some of the Japanese manufacturing techniques. The manufacturing technique basically was, or still is, the goods don't become a part of inventory. They essentially are going from the manufacturer, and a lot of these organizations will have these small manufacturers around the major plant where they're manufacturing these key components. Instead of going from buying inventory and then moving it to cost of goods, is essentially it's going from the vendor directly to cost of goods. So we're bypassing inventory. So the risk is then going to the manufacturer, the primary source of the component, as opposed to you. Gets it off your book as inventory, and essentially what's taking place is that inventory is then going directly to being a part, if it's a manufacturing, a part of work in process, and then finished goods. And then we're reducing finished goods from the perspective that we're actually not manufacturing until we get the order. One of the interesting things is, I'm not sure exactly how it works right now, but if you were to buy a computer from Dell, okay, so Dell, famous in terms of just-in-time. And basically what happens is that they don't manufacture your computer until they get your order. So what that means is that on the front end, the goods that become, the components that become a part of the manufacturing process come in from the various component people. Dell essentially is set up where that the components go from the component manufacturer to the Dell assembly line on a just-in-time basis. So they bypass inventory. And then on the finished goods side, basically they're not manufacturing your computer until you've actually ordered your computer. So they then reduce or almost eliminate inventory on the back end. So everything then flows through the manufacturing just in time, doesn't go to inventory, and then on the back end it goes directly to the customer once it's manufactured. An extremely efficient system, and the efficient system essentially works. Like I said, it works when it works. When it doesn't work, it can be catastrophic. So this demand pull and supply push essentially can create a significant efficiency within the organization, but again, only if all these other variables work out. It can be particularly useful when carrying costs and shortage costs are relatively high. And again, kind of think about the situation with computers is technology changes all the time. So you want to make sure that you're not stuck with component parts that are basically become worthless in several months. So you're always kind of working through the system and making sure that these things are done in such a way where we have efficiencies. So we see it's not just an accounting issue, and let's just kind of bring this back to the controller. So the controller essentially is probably going to be responsible for the purchasing process. Controller is probably going to be responsible for components related to the manufacturing process and inventory. He or she essentially is looking at this, again, not just from a credit and a debit perspective, but looking at it from a very holistic perspective. And as we discussed, is it can be quite risky. When it works, it is extremely efficient. When it doesn't work, it can wreak havoc on the overall process. So what many organizations would ultimately come up with is some sort of modified just-in-time inventory where they are keeping the inventory low with the expectation that there is a just-in-time mechanism that actually works, but at the same time having sufficient inventory on tap so that if something bad happens, when we're looking at just-in-time, is we need to drive variability out of the process. So variability out of the process is we need to have a very structured production, delivery, order processing, receiving shipments. And what we mean by this is just kind of think about what we want. Is we want firm commitments from vendors. Firm commitments from vendors occur because they're resting their future on your viability. So what do they need? Well, they need paid, so you need to be able to pay them on a timely basis. They need basically a commitment that you're going to be using these goods on an ongoing basis. You need very specific production, delivery, and order processing details. So we're looking for efficiency in the ordering process. We're looking for efficiency in the receiving process. We're talking efficiencies to the point where we're looking for those goods to arrive at our dock at 3 p.m. as an example. So when that happens, then the flow actually works. The problem, of course, is that traffic problems and all these other issues are going to create additional risks related to this. But to the extent that we're able to drive out the variability, this is what we need to do. And the way we do this is by creating a very trust and committed relationship with our vendors. It doesn't work if we are in an adversarial position with our vendors. We need to have reliable suppliers, and what we mean by this is they're going to be reliable because we have developed a strong relationship with them. You can't do this in an adversarial relationship. There has to be trust, there has to be commitment, not only on the vendor's part, but on your part in terms of sustaining this relationship, because basically it's like a marriage. Is once you're going down this path, it's very, very difficult to extract yourself from one type of relationship or organizational commitment to get to another one. So you need to have these things up front as you are developing this process. You also need to be able to forecast sales or get customers to place orders in advance. And what we mean by this is these vendors are relying on you because they have employees, they have suppliers that they need to get the goods from. So the trickle-down effect in terms of the supply chain can get quite complicated. And the only way it works is that if we're able to provide firm commitments related to sales, or as we were talking about as with Dell, is they're not really manufacturing. Theoretically, they're not manufacturing your computer until they actually have the cell for your computer. So these are the components that we need to understand as we are developing this relationship. And in the last slide is what we stated explicitly was the fact that we need to have a strong relationship in terms of making sure that this actually works. Other inventory control issues is the impact of inventory errors, cutoff. So when you hear the term cutoff, what are we talking about here? Well, what we're talking about is making sure that what is inventory this year and cost of goods sold next year is in fact what we're saying it is. So, and you'll see this in CPA questions, is sort of what happens at that cutoff point. Is at what point is it an order, and at what point have we the sales transaction actually completed? Why is this important? Well, this is important because we don't want to record inventory and cost of goods sold in the same period, nor do we want to sort of miss both of these. And what we mean by this is if it's inventory, it's not going to be cost of goods sold. That cutoff period in terms of defining exactly when the transaction is complete, and when the transaction is complete, these goods are no longer inventory, but they're cost of goods sold. So we need to understand some of the variances or the nuances related to understanding how we're actually managing the cutoff. We need to understand inventory valuation. A process that we go through related to inventory valuation is what we call the lower of cost or market. So basically what we're saying in lower of cost or market is that if the inventory has lost value, then we're essentially needing to create a reserve, and this reserve essentially lowers the value of the inventory and then creates an expense that becomes a part of our cost of goods sold. So the valuation method, lower of cost or market, is essentially a valuation system that we need to consider. We also need to consider the valuation system from the perspective of, are we going to do LIFO, last in, first out, FIFO, first in, first out, or some sort of average cost. Managing inventory from these perspectives is frankly not easy. We also want to consider the fact that we should probably be doing a perpetual inventory system. So a perpetual inventory system essentially is a point of sale inventory system where that as we sell the good, so if we sell the good, we have a debit to accounts receivable, or cash, and a credit to sales. But simultaneously with this is we have a debit to cost of goods sold and a credit to inventory. So what this means is that at any given point in time, we have an accurate count of what our inventory is. Why is that important? Well, that's extremely important because we're able to track our inventory. In a periodic system where we're simply doing a physical inventory count at year end, we are able to count the inventory. The problem is that the difference between the inventory, beginning inventory plus purchases minus ending inventory is cost of goods sold. That's the formula. But the problem is that we don't know if the cost of goods sold is truly related to what we actually sold, or in fact it is simply goods that have expired or were stolen or lost or thrown in the garbage intermittently. We're actually not sure what happened to the inventory. We're simply charging this to cost of goods sold. That's the problem with a periodic inventory system where we simply do a physical inventory count. In a good inventory system, we're doing a perpetual inventory, and then periodically, in fact quite regularly depending upon the type of industry, is that we're actually doing a inventory count, a physical inventory, and that physical inventory is then compared to our perpetual inventory to find errors. And the more often we do a physical inventory count, the higher the probability that we're actually going to determine where the risk is in terms of why the inventory is not counted accurately. We need to understand other components, unique components within the product design. We also want to consider obsolete inventory. So when we talk about obsolete inventory, one of the things that we need to understand, if we don't do anything about it, inventory stays on our balance sheet at cost. The problem is that we need to observe this inventory and make sure that it still should be at cost. So I threw out this term that we used of lower of cost or market. So we need to ultimately continue to evaluate our inventory and make sure that the cost is appropriate. If it's lost value, then we need to adjust the inventory as determined. Really the responsibility of the controller to do this. However, if the controller is not doing this, chances are these are the kinds of things that are going to be picked up by the auditor. So what is the auditor going to do? So the auditor is going to talk to the sales team. They're going to say, okay, well, I see you've got 10,000 of these items in your inventory. Tell me about how you're able to sell these products. And when their response is, oh, we can't give that stuff away, nobody's interested in it, that's probably a telltale sign that, in fact, there is a valuation issue related to that inventory. So we need to be proactive and make sure that we are appropriately allocating the inventory. Okay, so let's talk about some very specific metrics. And so we've got here inventory turnover, or days to sell. So what we're looking at days to sell is we are attempting to determine what is our average days of the inventory that we have in stock. And we do this based upon our inventory turnover and the number of days in the year. And if days to sell essentially is saying, okay, so we've got inventory stays on our shelf for 7 days, or some inventory stays on our shelf for 45 days. That information becomes very important because we're able to then determine if in fact we have too much inventory. Gross profit essentially is our gross profit. Gross profit is sales minus cost of goods sold divided by our sales. So gross profit divided by sales the gross profit divided by sales is our gross profit percentage. This becomes important because what we want to do is we want to consider this from a period-to-period basis. We also want to consider this as compared to other organizations in the same category that we are. And what this is going to tell us in some ways is it may tell us that there's a problem in terms of our inventory count. It may tell us that we've essentially counted our ending inventory inappropriately, and in fact our cost of goods sold is not the correct number. We're also interested in excess inventory, cycle time, and unscheduled downtime. So unscheduled downtime is going to be essentially understanding that there is a cost associated with not having the inventory. So if there's a cost associated with not having the inventory, what we're concerned with is making sure that the inventory stays at a level where we're not going to have any unscheduled downtime beyond our other unforeseen circumstances. Number of unique components per product. One of the things that many manufacturers look at is, could we actually simplify the manufacturing process to reduce the number of components that each product have? Goes well beyond, maybe well beyond the scope of the controller, but what we want to consider is the more efficiencies that we have in the manufacturing process is the greater the probability that we're going to be able to manage the inventory. When we're looking at metrics, we're looking at scrap, rework. Let's just kind of talk through each of these. So scrap is in some ways a component of the process. So scrap is where we essentially have the raw materials, and maybe we're cutting a pattern out of the raw materials, and then we have scrap, which is kind of the edge of the material. Okay, so that's fine. Well, possibly some of that scrap material can be resold. We also have rework. So the idea is that if we have inefficiencies in the process means that we may in fact need to do certain rework on specific products. As we're looking at the manufacturing process, we want to look at it from a very holistic perspective. And again, inventory is a part of it, but there's so many other things that become critical in terms of our understanding of how to make the manufacturing as efficient as possible. And if we are looking at it correctly, we are essentially taking a look at the whole manufacturing process, again, from a very holistic perspective in terms of inputs and outputs, and observe it and determine if in fact there are additional efficiencies to be had. Sort of what I'm describing here might be some sort of lean project or a Six Sigma project where we're observing, we're doing very specific calculations, and we're making recommendations, and these recommendations are to move the process to a much greater level of efficiency than what we have. Ongoing delivery, on-time deliveries So if we're committing to have the orders out 3 days after the order is given, well, that's a target. And the issue becomes is, what are we doing to actually determine, are we actually meeting that target? Any type of metric that we have, and in fact there should be many metrics as we are working through the system, is we need to understand it from the perspective of, are we actually managing the process? If we're managing the process, then these metrics are going to show us that in fact we are. And chances are, if we're having a problem with ongoing delivery, it may mean that we're not having enough inventory. It may mean that there are some additional inefficiencies related to the manufacturing process. Whatever we're attempting to do is we need to understand that the metrics tell us some very specific information. It may not tell us exactly what's wrong, but it may tell us what is potentially taking place. So on-time deliveries outgoing, on-time deliveries incoming. So if we're having a problem with the manufacturer, and the manufacturer for these component parts is not delivering on time, we need to understand this. We need to understand this from a number of perspectives. It may not be the manufacturer's fault. It may be the fact that, you know what, maybe if we paid just a little bit more for that manufacturer that was 10 miles closer to our organization, we might be able to justify that because of increasing the on-time. Again, we need to work through this from a very metric-driven process to make sure that the efficiencies are as are there to the extent possible. Incoming shipments for errors, wrong product, damaged goods, incorrect number of products, all these things can wreak havoc on your just-in-time accounting system. So if you're ordering the appropriate number of product with the expected lead time, and they're coming in and they're shipping the wrong number, the wrong product, they're shipping damaged goods, that's a problem. That's a big problem. And you need to be able to manage that from the perspective of making sure that they're doing what they're supposed to be doing. We need to take ownership of the total cost. We need to understand the process. And again, why are we talking about it from the perspective of the controller? Well, we're talking about it from the perspective of the controller because the controller is probably going to be the focal person in terms of making sure that these things are actually taking place. The controller is absolutely 99 times out of 100 going to be responsible for purchasing. Most of the stuff that we're talking about is purchasing. He or she is probably going to be responsible for specific components of the manufacturing process, and in fact the manufacturing manager is probably going to be reporting to the controller. Controller is key to understanding all these. Okay. Turnover is the number of times inventory turns over in a period. Now what we mean by this is the higher the number, the better. So if we're looking at a year and the inventory turnover is 12, it basically means that inventory is staying on our shelves for 30 days before it actually turns over and turns into cost of goods sold. Okay? So inventory turnover is the greater the number, the better. We take an inventory turnover and divide it by the number of days in the year, 360, 365, and we get our days inventory outstanding. And this is telling us basically how many days the inventory is on our shelves before it is actually sold. The cost of goods sold, so the turnover is cost of goods sold. Cost of goods sold is an income statement account divided by the average inventory. Average inventory is last year's inventory plus this year's inventory divided by 2. So that's our average inventory. So the turnover is cost of goods sold divided by average inventory. And then if we take the 365 divided by the inventory turnover is we're going to get our days to sell. Okay, so again, if we're looking at the 365 divided by inventory turnover, and let's say inventory turnover is 12, we're basically saying that the days to sell is going to be around 30 days, around a month before we're actually selling this. Develop targets for inventory levels, dollars, amount of days, for example, and periodic inventory counts, check counts to records. So what we're saying here is that we're not saying that the inventory control is just a periodic inventory system, but what we're saying is that the perpetual system, where we are recording transactions as they occur, is supplemented with systematic periodic inventory counts so that we can actually find the problems. We find these problems and we can address these. Check the counts to records. People with access to physical inventory do not have access to records on inventory or the ability to write off inventory. This essentially is a segregation of duties issue. We want to make sure that people are doing what they're supposed to be doing and they don't have access to a process where that they can hide any type of inappropriate behavior. One of the interesting things related to inventory is how the product return process can in fact be used to hide someone stealing inventory. So, because essentially is what we're saying in product returns is we're essentially moving the things from cost of goods sold back to inventory, but we want to make sure that it's done in such a way that there's no potential fraud. Surveillance, having cameras, very important. Just being aware that certain types of inventory are prone to manipulation and prone to being stolen. So we need to understand this and do an appropriate control system, which generally speaking will mean some type of surveillance. Periodic tests for obsolete inventory, we've talked about that. Theft prevention tags, we want to make sure that there's some sort of mechanism where we can track the inventory so that if someone steals the inventory or just casually takes it off a desk, is that we're able to figure out very quickly that this is gone. Only use approved vendors, evaluate vendors, restrict access to inventory, especially high value items. In the healthcare industry, pharmaceuticals, essentially there are very specific and enhanced controls over drugs that are highly volatile and so forth. So we need to have restricted access, high valued items. I remember taking a tour of the cafeteria, and we were doing an inventory count. So I went into the freezer with the inventory manager, and in the middle of the freezer was a cage, and I had a lock and key on it. And I said, well, why do you have this? And he said, well, we put the steaks in there. So the idea was that they put the steaks in there, and the reason they're under lock and key is that this is a highly valued item by other employees, and if you don't lock them up, they're going to get stolen. So the idea is you restrict access to inventory, especially these high value items that people desire. So anything that has a value outside the operation is we need to understand this. Restrict what employees can bring into work. So everybody have a wonderful evening. We will talk to you in 2 weeks, and I thank you very much, and we will go from there. Okay, thanks a lot. Okay, bye-bye.